Good day to one and all. This is Dr. Sivaraman of iknowindices.com. Hope you are able to hear me. Let me present the PowerPoint presentation. Tracking the forex market together, part 1 on December 10th between 9 and 9:45 GMT. So we will track the market using the live market code page. I will give the link for the same and you can open it in a browser. Case of USD CHF also, the move is just about 35 to 37 pips and the low is 0.8798, the high is 0.9835, 18 pips negative net change is seen. Then in the case of Canadian dollar, 1.0106, 1.0110 are the current levels, 1.0092 is the low, 1.0013 is the high, 2 pips positive net change is seen. And in the case of Australian dollar, 23 pips positive net change is seen. So Euro and GBP are showing USD weakening move, and USDN and USD CHF are making also USD weakening move nominally. But in the case of commodity pairs, they are showing positive net change. So when Canadian dollar is showing positive net change, that shows it is showing USD strengthening move nominally, and Australian dollar is showing USD weakening move. It is a contrarian move. When they make such contrarian moves, we know very well they are focusing on the crosses. Because of that, you come across GBP has gained, whereas Euro is holding near that of the low. GBP is holding above that of the high. So let me just display to you the initial lows and the highs set for today, so that we will be able to make a comparison with that of the current market levels. Then we will be able to take the trading decisions easily. And these are all the levels from that of Monday, and today is Friday, and it is 10th of December. Euro formed the low 1.3222, which is intact even currently, and 1.3255 is the high. So from there it went up about 30 pips as a stop, and it went up to 1.3281 and came below that of 1.3255. But it has not breached the low. So there is no bearishness here, and it's a question of only making an upward stop and making a dip coming closer to that of the low without breaching the low. If they hold, then after handling the crosses briefly, they are expected to rise and cut the high and go above. So that is what we know very well. After the false move, they are expected to show the extended move. So I explained in my trading system the type of moves. They do it in sequence. So they made an upward stop and made that drop and came closer to that of the low and not breached the low. It is a false move. That means if they don't breach the low, then subsequently in 30 minutes they are expected to gain the levels and go above that of 32.55 slowly. Then afterwards quick rise could be seen up to 32.55 is the initial high. After that they will make a slow gain. Then afterwards up to 32.81, that is the current high, and then you will come across more rise, quick rise happening above that. So they could easily reach 1.33, and it is a great buy opportunity. And in the case of GBP, 1.5749 was the initial low, which is intact, not breached. And 1.5782 was the initial high. They breached the high and they are staying above that of the high. And the new high was 1.5824 and currently trading around 1.5815, 1.5819. So they are still above that of the high for 1 hour from the start of the session. So above that of the high, we can do a technical trade. Buy above that of the high, keep a stop below that of the high. That sort of trade we can do it as a technical trade. Then in the case of CHF, you come across subdued move. They breached the low and formed the new low, 97.98, and then 97.24 was the initial low, and they are still holding closer to that. When Euro has made about 1 pip positive net change, CHF has dipped about 19 pips. So you could come across little more downside move about 10 to 20 pips, and then subsequently they are expected to gain the levels as a contrarian move, because you find that Canadian dollar and Australian dollar are showing positive net change, that they intend to make the contrarian move, not the regular USD weakening move or USD strengthening move. So you have to read the market or intentions of the players by their market moves, understand, then try to take trading decisions. I'll explain to you how exactly the trading decision can be taken step by step today. So it will be useful for you to make an understanding of that, and it might be beneficial for you if you try to follow this in a demo trading platform. And once you find the system is really usable, then probably you can deploy it in your real trading account. In USD which has made a subdued move, 83.68 is the low, and they breached the low by 2 pips, and currently they are trading around 83.67, 83.70. They made a brief downward stop by about 2 pips, and they are holding above that. And then 83.84 is the high, which is also intact. So you don't come across much move in the case of USD yen. In the case of Australian dollar, you find that 98.29 was the low, which is intact. They are not breached it, and 98.67 has become the new low, whereas the new high was 98.56. So they are holding above that of 98.56, similar to that of GBP. Only in the case of euro, they breached the initial high and come closer to that of the low. That is mainly to handle the crosses, not the real weakness of euro. So in the case of Australian dollar also, we can do a technical trade, buy closer to that of the initial high, and then try to book profit when they rise it and keep the stop below that of the initial high. In the case of Canadian dollar, 1.0098 was the initial low, and they breached the low and formed a new low, 1.0092, and currently above that of 1.0098, the initial high, and the high was 1.0113, which is intact, and they are likely to breach the high because they are showing positive net change in the case of Canadian dollar from the start of the session. So why I am just giving this initial lows and the highs, which are between 230 and 330 GMT, that is early Japanese session, because they are the levels which are used as the reference levels by the big players, and from there they try to make the moves. So we should also try to follow those levels, and then it will be really easy for us to track the market. So I have given you the initial highs and the lows also in the blog for your benefit. Let me minimize the PowerPoint presentation and go back to that of the other presentation. Now, before entering into that market, we should know what session we are trying to trade. So Japanese session is from 0030 to 0730 GMT. 7 to 7:30, 7:30 to 8 GMT is the gap time. So during the gap time, you would have noticed that euro and GBP were trading near that of the current high. Then that means gap time moves or false move, and they intend to make the move opposite to that in first 30 minutes. That is what exactly happened. From that of start of the European session, they started making a slide in euro and GBP, but GBP the dip was about 20 to 22 pips. In the case of euro, they dropped nearly about 40 to 45 pips. Then subsequently, that European session lasts till 14 GMT. 14 to 14:30 GMT is the gap time. Then US session starts by 14:30 GMT in a standard time frame. The daylight saving system is off now. So 14:30 GMT US session starts. By 15 GMT again, I'll come back and present the part 2 of the Tracking the Forex Market webinar, and I will explain to you again what we have tracked during that of the European session and what happened to that of the US session, so that you'll be able to find a system by which you can track the market. Now, before going into that of the trade, I want the traders to consider the factors. So factors to consider before entering into that of the trade. What are the factors? Track the market using GMT timings. So GMT timings, if you use, you will be able to understand the 24 hours market cycle rather than your local time. The local time is ideal for your appointments, etc., for your local understanding of what is happening in a local country. But if you try to understand an international market, wherein you find the market is for 24 hours, GMT time frame is ideal because the players are also following GMT time, and that is why I insist everybody to follow the GMT time and relate the market to that of the GMT time from time to time. I have given the session-wise timings, so those timings you can understand and identify the session. Whether it is a gap time, 7:30 to 8 is a gap time, 14 to 14:30 is a gap time, like that. You'll be able to identify the gap time. Then also the session start time, I have given it in the previous slide, that 0030, the Japanese session start, 8 GMT, European session start, 14:30 GMT, US session start. Then from the start, 1.5 hours is the early session. Then followed by that is the mid session. The last 1.5 hours is the late session. So you will come across the last 1.5 hours and 30 minutes of gap time. The first 1.5 hours of the next session, the market will be very, very active with regard to the majors. So then afterwards, mid sessions, they will handle the crosses. So if you are trading in crosses, you can focus to try to trade during that of the mid sessions. But if you are trading in that of the majors, try to choose either the start of the session, end of that session, or the gap time. So you have to choose the time, whether you are available for trading during that particular time, you have to identify and accordingly select the right session and also the right time and also the currency pair. So how exactly you have to choose the currency pair? Okay, let me do trade in euro, or let me do trade in GBP or in yen and things like that. How to take a decision on that? So which currency is ideal to trade at a given time? Because ultimately we are here in the market in order to make money. If a currency makes a quick move, then obviously you will be able to earn good money. And if the currency is making only about 10 to 15 pips move, then we may not be able to make the required money. So obviously the risk will be less because your stop may not be triggered, but ultimately you may not be able to earn the required money. So a currency which is showing a good spread will always give the scope for you to trade. Then for that you have to use the live market code page. I have given the link in the window of the hotcom, that you can save it in your favorite and they just open it in a browser and see where the currencies are, and they are all related to that of the GMT time, so it's easy for you to track it. Then make a note of the high, low and net changes. What I had done just now, just relating the market from that of the Japanese session to that of the European session. So I had tracked it and explained what has happened. So during the start of the Japanese session, they just opened near that of the low and then firmed up and went above that of the initial high. Then during the gap time, they made the gain, and then session start of the European session, they made the slide. So you are able to track the continuation of that particular market. Then it will be easy for you to derive what could be the next possible move. So compare those net changes to that of the current market condition. If you attract the market from Japanese session, then probably you will be able to easily understand that in the case of euro, they are trading near that of the low. In the case of GBP, they are trading above that of the high. So that way you will be able to track it. In the case of CHF, they are trading below that of the initial low. And in the case of yen, very subdued move is seen. And in the case of Canadian dollar, they just came down and went up, and they are just holding around that of the initial low. Australian dollar also, they are holding it above that of the initial high. So this way, if you just make an understanding, you will be able to choose the currency. Okay, if I want to trade in euro, then probably I'll try to take a buy position near that of the low. And if I want to trade in the case of GBP, I'll try to keep a buy order slightly above that of the initial high and below that of the psychological level 1.58. The psychological level 1.58 is seen, and we can keep about 1.5790 as the limit order to buy, because 87 was the low, and then they could probably, because they are holding above that of 1.58 without gaining levels. So they are simply holding it in order to handle the crosses. Before making a rise, they will make a dip and rise. So you know the cunningness of the players. If they want to rise, they will make a dip and then rise. If they want to drop, they will quickly make an upward stop and then drop. And yesterday you would have noticed that during the US session, they quickly dropped around 15:30 GMT in the case of Euro to 1.3166 and went above in 1 hour time, above that of 1.32 and started gaining the levels. And those who have been nervously liquidating would have repented that why I liquidated my long position and they gained the levels. So this is what they do it on a daily basis, a downward stop and followed by an upward stop and. So we should be able to understand and try to make use of such stop ends for the entry purpose. Then identify the currency which has made spread like 40 to 50 pips like Euro and GBP. You come across the spread is good. Whereas in the case of USDN, the spread is very minimal today. So it is not advisable to enter into that market currently. Then in the case of CHF also, the spread is very limited, about 30, less than 40 pips. Then in the case of Canadian dollar also very subdued. Whereas in the case of Australian dollar, they made about 40-45 pips. So the ideal currency to trade today will be Euro and GBP. So this way you can just identify the currency. Then the current levels, whether closer to the low or closer to the high, you have to identify. Then avoid taking position in the middle level. Either you should be able to take it closer to the low or as a buy position or above that of the initial high as a buy position. These are all the two levels wherein you can take a buy position. Similarly, you can take a sell position near that of the high or below that of the initial low as a technical trade. So that way you can choose whether I am going to do a buy and sell trade or a sell and buy trade. Just because Euro is holding, GBP is holding around 1.58. Okay, it is closer to that of the high. So let me take a sell position if you think that it may work wrongly. Because they are not breached the high, but at the same time, they are not dropped below that of the initial high. So this way, the initial lows and the highs will help you to determine which way I have to do the trade. And you can use the market reading as an additional input for that. Then the forecast if you want. Then the entry in a session, we can buy near that of the low or sell near that of the high when the low or high has not been breached for 30 minutes from the start of the session. So probably in the case of GBP, a small sell and buy trade would have been done from that of about 8:30 GMT around 58.24 and just covered it with about 20 pips profit around 58 because they came down to that level of 1.58. Then afterwards they are holding around that of 1.58, 1.216 currently. Otherwise, Euro gave that good opportunity of a sell near that of the high when they are not breached it and then would have booked profit of about 20-30 pips. Now, the opportunity is buy and sell trade in the case of Euro and GBP because we have seen the gap time, they gain the levels. So first 30 minutes they are expected to drop. That way they have done that. And afterwards they are expected to gain the levels because they are not breached the low in the case of Euro or any other currency. Then, similar to that of the entry decision, the exit decision is also equally important. Many people think that they are very good in deciding on the entry point and the exit point. Why there is hesitation with regard to the exit point? Because they try to take a buy position and subsequently they find the going is good and they identify a pivot point, identify as resistance and try to keep a limit order. It gets filled, the market goes up. Then he repents that I missed a great opportunity of holding it for a long time and trying to make a bigger profit. And even though the going was good, I just exited in a hurry. Later on, he thinks that why not I keep a limit at a higher level. Probably the market may not reach up to that level. It may show some profit and afterwards drop it. Then it may show loss. So you find invariably the traders, based on the past experience, develop certain own strategies without identifying such strategies whether they will work in the market or not. One of such strategies is avoid keeping stop. So they keep the stop at entry, they hit the stop at entry and quickly run up. Then they find that I missed the great opportunity of booking profit, instead I was stopped out at entry. Then next time they avoid keeping stop at entry. When the position was making profit, they show a loss. Then similarly, you come across a situation with regard to the exit. We are supposed to keep stop at entry and then subsequently trail the stop. They don't trail the stop because when they trail the stop, the market may swing and hit the stop and then subsequently go up. Then invariably they avoid trailing the stop and finally it may come and hit the stop at entry. So when such experiences are happening as the actual experiences, it is not theoretical, they are all actual experiences of the traders. So when such things happen, they try to avoid losing the positions, not losing the money, avoid losing the positions. What is the best way of avoiding losing positions? Don't keep stop. It's simple. So that is how you come across most of the traders have got the tendency avoid keeping stop. But that is not a wise decision at all. It may not work in the market. You know that market is so volatile, and if you try to trade without a stop, that means you are willing to take unlimited risk. So that you have to keep it in mind. You have to see the other side of the hedge, what could be the possibility. Then exiting the position with profit when the going is good near the opposite level. So you have to determine the level first of all. So if I take a buy position in euro 1.3227, for example, 5 pips above that of the high, then I should try to keep a limit order 1.3278, about 2-3 pips below that of the high, so that I will get a definite fill. That is why I am just trying to buy 2-3 pips above that of the initial low and try to exit 2-3 pips below that of the high. Why? Because what you see in the live market code page, there might be a slight difference in from that of the live market code page and your trading platform. Sometimes the trading platform might be showing 1 or 2 pips higher than that of the market code during the bullish time, and during the bearish time the code will be lesser than that of the live market code page. So you would have noticed it. If you are smart enough, you would have noticed it, and you can understand the trend, what the platform providers are trying to do. Then for a buy position, close near the high, keep a limit first of all, and for a sell position, try to close it near that of the low. That you keep it as the initial limit. Then subsequently you are able to keep stop at entry in your buy position or stop at entry in your sell position, and later on it is not been hit and the market started going upward. Let me take an example of a buy and sell trade. So in a buy, you find that the market is going up. Then subsequently when the market is going up, you are able to keep stop at entry, and then slowly you can trail it up, maintaining 15 pips difference from the other market. Otherwise, you can maintain even 25 pips in case if the equity is good. You can maintain up to 25 pips or maximum 30 pips. There's no point in keeping a trailing stop of 100 pips. No, that doesn't make any sense, because the trailing stop should be able to protect a minimal profit. So when the position is making about 40 pips profit, you can keep 25 pips trailing stop, so that at least if it is hit, you will be protected with 15 pips. And if you subtract the spread, then probably about 13 pips you will be able to get it. So that way you have to calculate the spread or calculate the distance of the trailing stop and then hit the limit. So if the market hit the limit, fine. If the market hits the trailing stop, okay, I'll get another buy opportunity during next dip, then I'll try to buy it after reading it for 30 minutes, the market. That way you can take a decision. And once the going is good, the trailing stop is not hit and they are come closer to that high, then you try to move away another 50 pips from that of the market. Continue to use the trailing stop and see whether the market is able to breach that of the high. If it breaches the high and stay above for more than 30 minutes, then you immediately see how much of net change has been done. Okay, they had done about 60 pips net change, and they can make another rise of about 90 pips in the case of euro. So you'll be able to determine in relation to that of the net permissible level, okay, another 90 pips they can rise. So from that of the entry, you can, from that of the net change, you can calculate how much will be the 90 pips level and then try to fix the limit there. Still continue to use the trailing stop because they may go up to that of the net permissible level or short of that. Sometimes they may breach it also. So you'll be able to maximize the profit. So this is the mechanism of maximizing the profit. Not simply using a trailing stop or putting stop at entry there ends that strategy. You have to continue to monitor the positions and see that you are able to maximize the profit. So every trade, if you try to maximize the profit, and you will come across that with less number of positions, you will be able to maximize the profit to a greater extent, and your equity can grow in a substantial way. Then, in the absence of hedging, with that of the crosses, you stop. So, when the position is making 20-25 pips profit, keep stop at entry and remove the hedging order or remove the stop so that your risk is reduced to nil or you don't make any loss of the money. Then entry exit can be fine-tuned by using limit orders rather than the market orders. When you use the market orders, you come across sometimes the slippage, sometimes the platform simply reject the orders, etc. If you keep the limit order, they are most likely to fill it up, and there are platforms they remove it also. But most of the occasions you will come across the limit orders are being filled without any slippage rather than the market orders. So if I want to buy euro, currently it is trading around 1.3225, 1.3227. The low is 1.3222. Okay, what I can do, just 10 pips below that of the current level, I can keep the order. Just watch for 10 minutes or they filling it up because they have come down, but will they be in a position to fill it up? If you find that they are not dipping, you continuously see that they are holding the level, then you modify it and try to keep it 1 or 2 pips below the market. During a small swing, they will be able to fill it. So always try to use the limit order to get that orders filled. Then avoid impulsive decisions like buy during rise and sell during drop. And this, you have to take it as a resolution that during the rise, they are trying to trap the buyers. No, if you try to buy, you will be the highest level buyer. Afterwards, they would have just stopped rising because your purpose of buying it there is quickly book profit. And after the visible rise, if you try to buy there, then you will be the last person to buy at the market. Don't be that way. Go with that of the impulsive decisions. Avoid that. And whenever they drop it and see that they stop hitting the low for more than 30 minutes, then try to buy it. Whenever they rise, stop hitting the high for more than 30 minutes, we try to exit out of the positions. So, in case if they breach the high or the low, what I am supposed to do? Then, if the initial high or the low are breached, identify the type of move. So, this is very important. Then you have to identify what sort of moves they have been doing it. Stop and. So, in the case of euro, you would have noticed that they made the upward stop and came below that of the initial low and a false move. Now, you find that from that of the initial high, they came up to that of the low. Still, they are not breached the low. Why? They can breach it. Nobody is going to tell them that is why you are holding closer to that of the low, but not breaching it. And so they have the mechanism of trapping traders. These are all the methodologies by which they trap the traders. So they have done the false move up to that of the low, and they have not breached the low. Then an extended move. In the case of GBP, they gained above that of the initial high and still holding above that of the initial high. This is an extended move, and they are expected to gain further levels. intentional move. So intentional move is they continue it for 2 sessions. It is similar to that of the extension move. After the extension move, they are supposed to reverse it. But after the intentional move, there is no need for them to reverse it. And that will be for about at least 2 sessions to 24 hours, not like extended move, only for about 2 hours. Then also sometimes they make extended stop. And I elaborately explained all these type of moves in my trading system. You can go through that and that will be helpful for you. The extended stop end is similar to that of the stop end for less than 30 minutes, but they do it in a very drastic way, about 150 pips drop and quickly reverse it in no time. Then for extended move, wait for 2 hours to enter and do counter trade. That is, sell after the quick rise or buy after the quick drop. So this is in the event they breached the initial high at the low. Okay. Then if they cut the high or low and stay above that of the high or below that of the low for more than 30 minutes, do technical trade of sell below that of the initial low or buy above that of the initial high, identifying the intentional move and exit with the same within the same session or the next session. So the trade which you have commenced as a buy above that of the high, you cannot hold it for a long time. You have to exit within the same session or the next session maximum, because afterwards they could just reverse the trend. So I explained to you with regard to when they are not breached the initial lows and the highs, how the trading decisions can be. And now I explained here when they breached the initial lows and the highs, what sort of trading decisions are to be. These are all the strategies one can follow so that you'll be able to easily take trading decisions. So now the forecast is a guidance, and in this session Euro and GBP are expected to make swing and rise. They are making the swing, they are expected to make the rise. So what position we are going to take? First of all, we have to identify the currencies. As I explained that the spread should be about 40 pips. So Euro and GBP have done it. Yen has not done it. CHF has not done that much. And Canadian dollar also not done that much spread. Australian dollar nominally they have done the spread. So let us keep a buy order. So 1.3226, they have come up to 1.223227. So let us see it's getting filled. Otherwise we'll trust and we'll keep a stop. About 30 pip stop, 1.3194. So you can identify what could be the support and keep the stop below the support, but still, no, that is not guaranteed. Even if you try to identify the support and keep the stop below that, the players know well that the traders know this is the support and they try to keep the stop below. Like yesterday, they came down up to 1.3166. What supports can do there? So they can simply come there and hit the stops and go up. So you take only a risk of 30 pips. Then in the case of GBP, I told you the initial high was 1.5782. 1.5782. So I'll keep a buy limit order 1.5786 with a stop of 30 pips. So I'll just watch whether they are coming below that of 1.58, because they are not breached the high. There is a great chance they could just go below that of the low to create below that of the psychological level 1.58, and then induce a bearish feel or induce the traders to do little bit of sell and buy trade and quickly reverse it also. So like what they have done yesterday during your session. So I'm just keeping it as a limit. So at this level I'll buy. When it comes closer to that, I will not remove it, because this is what normally happens. Whenever they quickly drop the market, we determine that okay, this level you can buy. But when it comes closer to that, if you try to remove it, then you find that okay, let me just watch where exactly they are setting the bottom and enter into the market. But they would have set the bottom below that about 10-15 pips and quickly reversed it. and if you place any order, they will not fill it. So that could happen. But anyhow, you are having a stop to limit the risk. So you are not taking unlimited risk. Always keep that in mind. Whether you buy euro at GBP at 1.55 area or 1.57 area, we are trying to keep a stop of 30 pips. At a given time, you are only taking 30 pips risk. And some may argue that the chances of stop being hit are to be estimated. But anywhere, if you try to keep the stop, there is no guarantee. And if there is a guarantee, then people can simply say trade without a stop. You have to analyze it. However, whatever the methodology, we try to use it to identify the market moves, but still the element of error is there, and even the analysts and the great experts are trading with stop, so small traders cannot avoid trading without a stop. So these are all the two limit orders I kept it. Sorry. The euro, they came up to 1.3227. They are not filled it. So I'll just let me check whether they can keep it or modify it and try to just place it above and try to take it. Just I'll go through the questions and answer to the questions, minimizing the PowerPoint presentation because the questions are to be answered now. I'll focus the camera over that of the live market code page. Okay, Arun. At the time of Japanese session close, euro was at 1.3273 and they gained only 8 pips during gap time and continue to slide, so that it is no mean for a false move. They are just swinging and creating the sentiments. But I do not want to argue here because you know that low was there and subsequently they set the high. They knew it. Today's high in GBP was made during gap time, yes, and not breached for more than 30 minutes, although was closer to that of the high without breaching. So a sell and buy technical trade. No, sell and buy is not a technical trade there. We can do a buy and sell as a technical trade. Sell and buy trade would have been done earlier around 8:30 GMT, but has sold and earned about 20 pips. So around 1.5824 and take a buy around 1.58 or 1.5799 when they came down. But not much of a scope was there. So always we have to find out whether we will be able to easily execute the trade. That is also equally important. Sometimes, you will be able to take a position, but exit becomes extremely difficult. You would have taken a sell position and you wanted to exit. After the drop, you think that, okay, they could drop further down, and don't keep any limit. Then they quickly reverse it and you miss great opportunities. You have to determine the exit there. So, here in the case, you know that the initial high was 1.5782. So around that, if they are not reached there in 30 minutes time, similar to that of euro, we should exit. Then they won't go. Looks like euro will go for bottom stop hand. Okay, yesterday they have done it and they have collected the stops, and today they don't intend to do it. It shows very clearly because they came closer to the low, and if they wanted, they would have done it. In Harry, why they don't do it? Because they are already trapped the lower level short sellers, the technical traders, and they do not want them to take profit. Only then they will come for short covering. So always they quickly drop and trap the short sellers during that time, quickly rise and trap the long holders. So you have to understand that is why I say that when they are dropping, don't try to sell. When they are rising, don't try to buy out. When they are just making a dip, try to buy, and when they are trying to rise quickly, you exit out of the position. Quick moves or false moves in the market. In Harry, what if there is a newspaper bomb news. Okay, so in the event of unexpected eventuality, we have the stop. So obviously, even the players try to limit the risk by that way. You find that euro is trading between 1.32 to 1.333 for several days in this week. You'll be wondering what big idea is there, whether they want to drop or whether they want to rise. You will be questioning it. But I explained it earlier. Whatever they buy, they try to rise about 100-150 pips, book profit and re-enter again after dropping it, and again rise it, book profit, re-enter again at the bottom. So when they do about 100 to 150 pips of this sort of shunning, what happens? Their average of holding positions will come down at least 200 to 300 pips below the market level with the added profit. Even though they would have bought it at 1.32 or 1.3166 and things like that, but the average will come to 1.29. Then afterwards, if they continue to buy it at higher levels and rise the market, and in the event of an unexpected eventuality, because in the world anything can happen like that as a sudden breaking news. Then in the event, if the market started dropping, everybody started selling, still they will not incur a loss. They can exit above their average buy level. They quickly gain the market or make the market volatile and then offload all their positions. And during such times you come across the market will be making very high volatile move like health sector. They create so much of rumors and things like that, and they will say, okay, there is a false news and things like that. They just spread it, or they can say that it is being under control and it's only a rumor. That sort of news they can do and reverse the market very quickly and just offload all their buy positions and exit without any loss. So you have to understand they're big volume players. When they are doing big volumes, obviously they cannot take chance of keeping stop. Hope, Harry, I answered your question. Then DTPT. Do you see USD CHF going to 97.50? I don't think so, because it came down just 2 pips below that of 0.98 and holding above that of 0.98, 0.9815. They are holding it. You know that 0.9824 was the initial low. They are still holding it, but no scope because the spread is very limited. Don't try to take a position during that time because they may do about 10 to 15 pips. And if they are doing it less than 40-45 pips or 50 pips, understand that they wanted to consolidate that currency on that day. There is no point in taking a position there. Euro, they are not giving a chance for us now. They are rising it. Doesn't matter. If you understand the concept, anytime you can trade. There's no harm in it. In Kung Fu. Due spread, 40 to 50 pip spread started in the presentation relates to high-low. Okay. Now, the spread between the low and the high. The spread between the low and the high in the case of Euro is about 60 pips. The spread between the low and the high is about 80 pips in the case of GBP. Then it could give a great trading opportunity. That means they wanted to make a good swing. Whereas in the case of Yen, you find hardly about 24 pips. And in the case of USD CHF, about 37 pips. So you don't find in the case of Canadian dollar just about 21 pips. What trading opportunity they could give? Tell me. Probably if they increase the spread, then later on you can enter into the market. But not immediately. That's what I refer to. Then new 8. Now Euro is moving higher. Will you buy at market? No, let them make a small dip, then we'll buy it. Then probably around 30 to 35, we'll improve the order and just keep it and see. Because sometimes they gain the level and just dip. Gain the level and then dip. So we are not emotional. We will not just like that grab it at the market and later on find that they started dipping. So we'll improve it by about 5 pips and see whether they are filling it. Because having consolidated for about 1 hour, and it is a mid-session, so they are not going to take up the market in a big way immediately. Probably from that of the second half of the European session, they could take it up. So it will take some time. Before that, they could make a dip, then our order will get filled. So let me modify the order to 1.3236. So just I am making the order 10 pips higher. Okay. Let's after gaining, they are making a small dip in order they will make such swing. Continued. Then if initial high is breached in euro, what action will it take? Okay, fine. Similar to GBP, now they are holding above that of the initial high. Euro also, the initial high was 1.3255. Then when they go above 1.3255 and sustain there for more than 30 minutes, then I don't mind even buying at around 1.3258 or 3260. So the time will tell you whom they are trapped, whom they are going to induce to book loss, whether on the upside the short sellers, on the downside the long holders to liquidate with a loss. So that you have to identify. That is a basic idea, no? It is, what is trend? It is nothing but we have to identify using various mechanisms which way they are going to rise or drop, or which way they are going to move the market, whether rise or drop. Okay, rise means then immediately you analyze technically and try to do a buy and sell trade quickly, exit it fast. You know very well when you come across it's a oversold condition, or it is a crisscross of SMA and simple moving average with any exponential moving average, etc., then you think of such divergence. Then immediately go for such trade. What is the basic idea? Because the players wanted to trap the short sellers, or the players wants to induce the long holders to liquidate. So that is what you indirectly identify. But instead we use the live market code page itself. Use the actual levels, because in the charts and statistical calculations, you come across one of the important thing, averaging. Because the market does not work on averaging. 1.3281 is 1.3281. If you keep an order, it will get filled, whether it is a stop or it is a limit order. Okay. Whereas in the chart, if you see carefully, it will show the high as 1.3273 and a small line above that. Then they call it as noise. But there again, the market is traded. So that is why I insist you to look into that of the live market code page to have a better understanding, live understanding of what is happening in the market. That is possible with the help of the tick chart, but it will become very, very cumbersome. Isn't it? The chart will continue to run. You will not be able to make any comparative study with regard to what happened 30 minutes or 1 hour before or 4 hours before. Whereas in the live market code page, nothing moves excepting the up and down moves of the price. So price action you can visibly see, rather than trying to derive it with the help of the chart. If you don't have much of a memory, then probably you have to try to use your chart study, wherein you have to find, okay, about 3 hours back what was the high, and 2 hours back what was the high, about 12 hours back what was the high. You can just refer to that. But if you have got a little bit of sharp memory, you can easily remember all these levels. Just remember the highs and the lows, how they handled it, and or make a note of it in a notebook. You'll be able to easily do it without any much of a sophisticated studies. Now knew it. Okay, it is a price in between the initial high and the low. It is no trading zone. Yes, obviously let them drop. Then we'll try to take a buy. They are just attracting the buy orders from the other traders. Just to gain the levels by circular trade and dip and distribute it before going up further. So also, you have to understand that they cannot take away all the positions by themselves, because the traders have to participate in that. Only then they will be able to earn from the other traders. So you have to understand that operator psychology to do effective trading. So these are all the two orders. I kept it. Still, they are all only limit orders because I thought that I should explain more with regard to the trading decisions rather than simply taking the position and showing the profit, etc. So if I make it very simple and step by step, if I give it, probably you will be able to really understand how you have to go about in trading. So that is why I taken more time with regard to explanation part of it. And so these are all the limit orders currently I have, and I'll just watch for another 30 minutes. If they are not filling it, and I will try to take it, improve the order slightly above, and whichever the currency I take the order, take the position, I'll just be happy with that. There is no need that I need to have positions in all currencies. Similarly, if I come across any opportunity in regard to the crosses, then I'll try to take position in the cross. That way, the trading decisions ought to be very, very flexible. Okay. So I take this opportunity to thank everyone who have come here. So again, we will review the market by 15 GMT during the start of 30 minutes past the start of the US session. And at that time, I'll explain to you what happened to Euro and GBP limit orders, whether they are filled or I modified and taken the positions in the market. And also what is the fate of that particular trade. I only kept the stop. So no hedging strategy I'm going to explain. So it is only with regard to the stop. If I am stopped out, I'll say I have stopped out. And if I booked profit, I'll say I have booked profit. Okay, you can try it in a demo trading platform also and see how exactly it goes. Because you should have started by 8:30 GMT. Doesn't matter, 9 GMT we started. So we'll try to enter into the market leisurely. Still, we'll be able to get the opportunity to trade today. So always choose to read the moves in all the 6 pairs as I explained, Canadian dollar and Australian dollar. Still showing positive net change. That means they are handling the crosses. That is why you come across lackluster moves. So see you again by 15 GMT and we will continue understanding the market. Thank you one and all.